So over the course of 2022, because of the market drawdown, there's a lot of investors who have been holding higher than normal cash positions, or they just have a surplus of cash right now that they're waiting to deploy into stocks at a better opportunity. Maybe they're more comfortable buying when volatility goes down, or they simply have a cash position that they're slowly deploying into the market. And for a very, very long time, we never got any sort of return or any sort of yield on these cash positions. We'd be lucky to make, 0.15, 0.25%, especially during the pandemic when rates absolutely collapsed. But fortunately for investors, the glass half full attitude to these rising interest rates is that high yield savings accounts have started to pay big yields. And I'm going to go over two opportunities of high interest savings ETFs that not only pay you yields in excess of 4%, but they are completely liquid. You can buy and sell these things just like a stock on the market. You could be in and out of it within seconds as long as the market is open. So in this video, I'm going to go over two different types of these funds from Horizons, and I'm going to show you the differences between each, and I'm going to go over some strategies that I'm using right now and many of our members are using right now with their higher than normal cash positions as they look to slowly buy into the market or possibly wait for the right opportunity, or maybe even they just have a large cash balance that they're waiting to put down on a mortgage or buy a car or something, and these funds can help you generate passive income in that situation. So let's get right into the video and go to the screen. So everybody, before we start, remember, smash that like button, comment down below, and subscribe to the channel. More likes, more comments, more subscribes means more free content. So in this video, we're going to be going over two ETFs. One is ticker CASH, C-A-S-H, and the other is ticker HSAV. Now, one very important thing to understand is if you are with a major bank, TD Bank, BMO InvestorLine, and Royal Bank of Canada. I am not sure about Scotia. I'm fairly certain you can buy these on Scotia iTrade, and I believe you can buy them on CIBC Investor's Edge. I'm not 100% sure, though. You'll have to double check. But TD, BMO, Royal Bank do not offer these ETFs. You cannot buy them. And I don't know the exact reasons for this, but I would say for the most part, it is going to be because they offer their own high interest savings funds. TD offers them, Royal Bank offers them. They do offer a little bit lower interest, but being at those brokerages, they pretty much force you to buy the funds from them. So unfortunately, you're kind of out of luck when it comes to these Horizon funds if you're with one of those major brokerages. So there is a very big difference between a bond or a GIC relative to these high interest savings ETFs. And you may get more interest, more yield from a bond or a GIC, yes, but the main driving factor is liquidity. When you buy a GIC, unless it's cashable at a particular period of time, and even then you're kind of tied in until a certain point, these ETFs are completely liquid. You can buy them on the stock market whenever you want, as long as the market is open. You can buy them and sell them 20 minutes later if you want. It wouldn't really make much sense, but I'm just trying to highlight the liquidity element of this. Your cash is significantly more liquid in a high interest savings fund like this than it is a GIC. Yes, you can very likely get rates of 5% or more on one-year GICs right now, even longer-term GICs, but you're losing that liquidity factor. If you're looking to buy a car in 6 months and you have bulk savings that you want to put towards that, you can't buy a one-year GIC because you need the money in 6 months, whereas you can buy a fund like this and still generate the monthly income off that cash balance you have and just sell it when you need to utilize the cash. So let's first go over the Horizons High Interest Savings ETF. This trades under the ticker CASH, and it has a price of $50 per unit. And as of right now, it has about 27,000 shares in daily volume. So this is a very low risk fund. So the main objective of this fund is they will pool money, they will head to the big banks, and they will invest that money in high interest deposit accounts with Canadian banks. Key features of this fund: enhanced saving potential. It invests almost all of its assets in high interest deposit accounts, as I've mentioned, with one or more Canadian chartered banks, which provide much higher interest rates than traditional savings accounts. You're never going to go to your bank with $10,000 and get them to give you the yields you're going to get on Horizons in a simple savings account. So another advantage is daily liquidity. This is an ETF that can be purchased and bought anytime during the trading day. So this is key advantage with other savings vehicles, which typically have minimum holding periods or investment amounts. Like I said, minimum amounts on GICs and the holding amounts on GICs factor in huge. And secondly, with cash, it makes monthly distributions. So this is essentially to maximize your savings potential. So if you have a cash holding, if you have a large cash holding right now, whether you're saving that money because you believe the market is going to go down further, or maybe you're saving up for a mortgage, or as I've mentioned, a car, you can use this fund to generate income off of that cash balance that is completely liquid. You can sell it whenever you need that money. So say you have a cash balance, say you're holding your portfolio 25% cash right now, and you want to gradually buy stocks with that money. You want a dollar cost average in. The market's too volatile for you to lump sum it. You can buy something like cash. It will pay you monthly distributions, and then you can sell off portions of it whenever you want to put that into stocks. As mentioned, the gross yield was 4.29 on cash. It will very likely go higher. As I filmed this early in December, we haven't seen the December interest rate increase yet. It is very likely going to go up, whether it's 0.5%, 0.75, 0.25, I'm not sure, but it will go up. So this is highly likely going to yield even more. I believe the distribution per unit for cash over the last 6 months has gone from 2 cents a unit to nearly 17 cents a unit on a monthly basis. So gross yield of 4.29% right now, management fee of 0.1. So obviously Horizons is going to take a chunk of the interest earned as a fee. They're running the fund. We have to expect that. So you are not going to get all of that yield, but you are going to get most of it. If we go to my account history right now, I have 1,448 units of cash, and it pays me $238 a month. So if I were to hold this fund for a year, it would pay me, if rates stayed the same, it would pay me a total of $2,860, and I believe I have around $72,000 invested in the fund right now. So you're looking at around 3.97%, nearly 4% yield right now, and that is if it stays the same. As mentioned, yields are expected to go up, so it is highly likely that this will go up. So some key positives, negatives, pros, cons of cash. It trades on a stock exchange, as I've mentioned many times. This fund is completely liquid, whereas GICs and even high interest savings accounts at banks, they might have minimum deposit time lengths before you get that higher interest rate. They could have minimum dollar amounts. I know many of the GICs on the GIC rate sheet at Qtrade, they require to get the best interest rate, you need, $30,000 minimum, $50,000 minimum. With cash, you can buy anything you want, any amount you want, and you begin to gain interest on that money. So one negative, obviously, management fees. Cash and other high-interest savings ETFs charge a management fee. You won't get this with a GIC and savings account, but you also do unlock that higher yield that you typically would not be able to get with any particular amount of capital you have with a bank, unless it is a very large amount. Now, this is a very important thing to understand and is probably the biggest risk with these high interest savings ETFs is the fact they are not CDIC insured. So if you go to a major bank and you open a high interest savings account and you deposit money in it, you have CDIC insurance. So if the bank were to go insolvent, that money would be safe up to $100,000. Cash and other high interest savings ETFs are not covered by the Canadian Deposit Insurance Protection. So as I mentioned, cash, they deposit their money into high interest savings account at chartered banks. So if these banks were to go insolvent, the money that they deposited would not be protected. That is the main risk of this fund, even though it is so little. There is such a small chance of this happening. This is a fund that will go to banks like Royal Bank, BMO, TD, CIBC, Bank of Nova Scotia, and they'll deposit their money in these high-interest savings accounts. These banks would need to go insolvent for this fund to not be able to have that cash, for that cash to actually be at risk, and I just don't see that happening anytime soon. So as mentioned, yield, how do they get this higher yield? Well, cash has access to higher institutional rates that is typically not offered to you as a retail depositor. So the rates will fluctuate depending on the prevailing interest rate, which means it will most likely rise and fall with interest rates, and this is why we've seen such a large increase in yield recently. And then obviously the last note is liquidity. I've mentioned it time and time again. You can buy and sell this whenever you want, whenever the market is open. So when we go to Y charts and we look at a chart of cash, we can see that this fund, it kind of has a funky chart. And that is because this fund essentially gathers up the interest and then pays it out as a monthly distribution. That monthly distribution comes out of the net asset value of the fund. So this is why we see these gradual increases in price followed by a drop. This is due to the distribution paid. So you'll always see this hover around $50 a share after the distribution. Now we see here expense ratios of 0.12. This is a little bit higher than the Horizon's website, but still in the same realm. So total assets under management of $1.048 billion. And the one thing you'll see here, if we go down to inflows, you'll see $740 million in inflows over the last year. That is because this fund is pretty much brand new. It started in November of 2021, and on average back then, because interest rates were so low, it only paid out about 2 cents per unit. Now the reason I'm showing you this chart is primarily because we're going to go over HSAV next, which is the Horizon's Cash Maximizer ETF. Now, how is this different than cash? Well, first off, we can see its price is different. We can see it trades at $103.64 at the time of filming this. Now, this fund is a little bit older than the CASH ETF. It started in February 6, 2020, so it has been around for quite a while. So key features of HSAV, exactly the same as cash in the savings potential, the daily liquidity, but again, where it differs is tax efficiency. HSAV does not pay you a distribution. So you could see that I'm earning $238 a month off of CASH ETF in my cash account. With HSAV, it will not pay that distribution out. Instead, it will continually reinvest it. So net interest income from high interest savings accounts are reflected in their NAV. So your net asset value, your share value with HSAV will increase, whereas with cash it stays exactly the same and they just pay it out as a distribution. Now you might be asking me why I own cash in a cash account. I'm paying 100% tax on that interest. To be honest, it's simply because I didn't know that this fund existed when I bought cash. If I would have known, with this being in a taxable account, I 100% would have bought this, because ultimately it is more tax efficient. You're paying capital gains on the sale of units, which are taxed at 50% of that capital gain, whereas interest income is taxed at 100% of the income you receive. So that is very important to keep in mind. So again, this is a huge advantage of this ETF, particularly if the shares are held in a taxable account, where tax on interest income could potentially be in excess of 50%. That depends on your marginal tax rate. You would need to be making a lot of money to be marginally taxed that much. But with cash, you can't avoid the taxes if it's in a taxable account, where with HSAV, you can kind of play around with it and, defer taxes or line up taxes when selling units to kind of work out in your favor. So let's go to Y charts and look at a return chart of HSAV, and we can see how much it differs from something like cash. With cash, because it pays that distribution that comes out of the net asset value of the fund, we could see a dramatic upward trend and then a downward spike when it pays out the distribution. But with HSAV, because it reinvests the interest earned in those accounts, we can see a gradual increase in price, one that has significantly increased because of the rising interest rates in late 2022. And we can see with this, the expense ratio is a bit higher at 0.18, so you will pay a bit more in order to have access to this fund. And we can see that total assets under management, this fund is twice the size as cash, primarily because it's older, but also just because it is more tax efficient. If we go down to the 1-year inflows, we can see that almost 1/3 of this fund's assets under management have come in the last year. And that is because these funds are becoming insanely popular because of the rising interest rates. Now, in terms of performance, which fund has performed better? And on a post-tax basis, if you have this in a taxable account, HSAV will always outperform cash. You can defer taxes, whereas with cash, you're getting that interest paid right away on a monthly basis. So you'll be hit with a tax bill every year. But the dramatic increase in interest rates over the last year has actually resulted in HSAV outperforming cash on an overall basis. And if we think about this, it actually makes complete sense. We have something like HSAV, which is reinvesting your earned interest at higher rates. Remember, when we go back to June or July, when interest rates started going up aggressively, prior to this, when interest rates remain the same, they would simply reinvest your money at the same interest rate. So ultimately, these funds performed very close to in line with each other. But as soon as interest rates started going up dramatically, HSAV was able to take your interest earnings from owning the units, and instead of paying them out and earning no more money on that distribution, it was able to reinvest that interest at a higher rate. So as interest rates started to accelerate much faster, HSAV started outperforming cash in a big way. We can see even during the midpoint of October, we can see that it was returning, quite a bit more, almost 50% more. Now, this will normalize. Once interest rates settle, once they stop going up so dramatically, this will normalize, and very likely these funds will begin to trade in line once again on a total return basis. But as I mentioned, if this is in a taxable account, you're almost always going to be better off owning HSAV. Now, in a tax-sheltered account, you could make the justification for owning cash, because if you are paid those distributions and you don't want to sell anything in your cash position, you could take those distributions and invest it into stocks. Whereas with HSAV, you might have to sell, and depending on whether or not you're with a commission-free brokerage, you might actually have to pay to sell it, and that might be a little more inefficient if you're looking to buy other stocks. You might want that distribution instead. It's something to think about for sure. So an alternative for those who have US dollars, Horizons has a US version of this fund, HSAV.TO. So this is a US dollar cash maximizer. So if you have US dollars that you want to store in one of these ETFs, you can just look up that fund and that will be the one you want to own. It's exactly the same fund, it's just a different currency. If you have US dollars right now and you bought HSAV, it would convert it to Canadian dollars. Whereas if you bought HSAV.TO, you would still keep that currency in US dollars, and it would sell in US dollars as well. But overall, these three funds, they're excellent options for those who want to make some money off their cash positions, their emergency funds, whatever it may be. So everybody, I really hope you liked the video. These are 2 great funds, potentially 3 great funds if you want exposure to the US dollar savings account. And depending on your overall situation, whether you want that distribution or you're willing to invest in something like HSAV, which does not pay a distribution, instead it reinvests the interest into those savings accounts and kind of compounds the returns internally, in which you can then sell those for a capital gain, which is, for the most part, if you have these in a taxable account, taxed much more favorably than the interest you will receive from an ETF like cash. In a tax-sheltered account, many people might choose cash. They might want the distribution, especially because they can take that distribution and reinvest it into other stocks as they hold that cash position in the ETF. Overall, I think a lot of people have ignored fixed income over the last, 10, 15 years, and that's completely appropriate. Bonds have yielded absolutely nothing, and these cash funds have yielded absolutely nothing, but I think now it would be a big mistake to ignore them, and if you have some extra cash, Whether it's because you don't want to deploy it in the market right now, you're waiting to put your down payment down, you're saving for a down payment, you have cash set aside, you want to buy a car in a year or something, this will help you generate income on that money with relatively, actually virtually no risk. The only real risk in these Horizons funds is that the underlying banks, which is for the most part the major financial institutions here in Canada, go under, because this is not protected by CDIC. But that risk is very, very low, and these are a great way to gain access to higher yields. You do just have to understand, as I mentioned earlier in the video, that some of the major institutions will not let you invest in these funds. I do not believe TD Bank lets you. I do not believe BMO InvestorLine does, and I don't think Royal Bank Direct Investing does. They have their own specific products that you have to buy through them. Typically, the yields are a little less, but it is very likely that you're going to get, 3.25, 3.5% from those institutions as well, which is still a very, very strong yield. Hope you liked the video. If you learned something in this video, smash that like button, head down below, subscribe to the channel, make sure to comment down below. As mentioned, more likes, subscribes, comments means more free investing content. We'll see you next time.